Well, starting week 2, here we go. So, week 2, you'll see we got a little more stuff going on. We got both chapter 2 and chapter 3, and chapter 3 has some exercises that you'll be needing to do. And in addition, I think there's quizzes for both chapter 2 and chapter 3. So we'll take a look, right? Okay. And I'm going to hit this first before I go to chapter 2, just so I don't forget. In chapter 2, the lecture, if you want to call it that, probably be the last one of those that you'll hear from me for a long time. You know, maybe at the end of the semester, there's a couple other chapters that really don't have much for exercises or problems, and so I may kind of throw in a little lecture at that point too, because we talk about some other concepts. So chapter 2, you're just going to have the quiz, and I've set it to be due on the 20th, which is, what's that, Friday? Yep, so get that done, okay? And then chapter 3, by Sunday, okay, you'll need to do the assignment. I want to quickly kind of show you the assignment and how those will be done. So if you come here under week 2, right, chapter 3 assignment, you'll see there's this Excel spreadsheet. Down below is the assignment folder, or what I would call the Dropbox, where you'll submit it. But if you click the down arrow, you can download the actual Excel spreadsheet, and you get that opened up. Of course, you got to hit enable editing. You know, you might want to go full page. You'll note that I have the assignment already for you, and there's tabs down here, and so this assignment's the same as what's in the book, other than I've probably changed the numbers a little bit here and there. And so you can see you've got problem 2, problem 3, 4, 7, 10, and 13. Okay, now if you go down here, you scroll down under week 2, you'll get down to where you'll see these videos. Okay, and these are all very short videos, but it addresses each problem in some manner that you will be doing. And you know, normally I've chosen a problem that's nearby, or I've chosen the same problem and just kind of changed the numbers again in my demonstration. So I walk you through exactly how to do each problem. I'll tell you number 13 gets to be there's not any problem solving there, and so that has put a lot of students they get a little consternation when they get to number 13. So think of that in terms of the balance sheet. And the balance sheets, you know, don't change, but what's different about the balance sheets when you look at 313 for the company in question or the industry in question? There's something that's obviously very different about the balance sheets based on the information that you're given. So think about that. But watch those videos. Again, they're very short. Walks you through each problem, walks you through how to perform them. Do them in Excel. You can do them right, you know, below here. Let's go back to this one. I encourage you to be diligent about how you put these forward, or how you present these. Okay, it'll make your life a lot easier as we go along through problems as we get going. Is set up the problem. You know, write down the facts that are in there. You know, database systems is considering an expansion to a new product line. Assets to support expansion will cost $420,000. So, you know, you're going to have a line in here someplace. You know, maybe skip a couple, then you can add above if you need to, right? Okay, so you got assets, $420,000, and you got annual sales, 1.56 million, right? 6% profit margin. And then it asks you to solve for that, and obviously the video that I've presented will go through that. So, okay, enough on that. Okay, I'd also like to now say, be thinking. Next week we're going to introduce Project 1, and be thinking about just simply a business that you would like to do financial projections for. Okay, keep it simple. Okay, think of a simple business. It can be one that maybe you're kind of interested in doing, or it can just be one just off the top of your head that you want to do because it seems like it'll be kind of easy for this project. Okay, keep it simple. And what do I mean by that? Well, your goal may be to own a 6-bay automotive repair shop at some point in the future, but let's start with repairing cars, on the weekends in your garage maybe, right? Okay, you can scale this up really, really easily once you get the the basics down. You can scale this quite simply, and so concentrate right now on just keeping something simple. Pick a simple business. So. Okay, that said, let's go to chapter 2 real quickly. And again, this will probably be about the last you'll hear from me lecturing, I guess, for, if you want to call it lecturing, for a while. Hopefully this will help you with some of those other things. So you got basic financial statements, and we spend a lot of time. Again, problem 313 is going to, there's some differences there on the balance sheet that you need to calculate. And a lot of this class is figuring out how these financial statements interact. Project 1 is like that. You'll find information from one of the statements goes to the other statement, and so on. And so it's important to know those, right? Statement of retained earnings has something to do with that, right? Short supplement to the income statement, and then that tells you what part of that is going to go to the balance sheet, right? So you got a balance sheet, and then you also have that statement of cash flows. And they're all very, very important. So the income statement, right, measures a firm's profitability, and you can see income statements that could go from daily to weekly to monthly to quarterly to annually. When I was in banking, we actually got a daily statement of condition. It told us our income for the prior day, believe it or not, plus where we were, the balance sheet part of it, on any given day. And that was kind of important for us. It allowed us to, you could kind of look through, you didn't read it necessarily line item day after day. It was pretty in-depth financial statement, but you looked at it and you looked for oddball things, that might show up because sometimes something got run incorrectly or whatnot. It allowed you to catch those things right away. Most businesses probably don't do that. Most businesses, you'll see quarterly statements. Publicly traded businesses are required to report quarterly, okay? So you got sales, right? And then you've got the cost of goods sold. You subtract that out. So if you're a retailer, that's pretty simple. If you're Master Sports down here, what's your sales? That's pretty simple, what you do each day or week or whatever. Cost of goods sold is what you're paying for those things, the inventory that you have coming into the store. Okay, that gives you a gross profit. From the gross profit, then you start subtracting your operating expenses, your employee costs, your heat, utilities, those types of things, phone, internet. Okay, and that gives you an operating income. Okay, or an earnings before interest and taxes. That's kind of nice to know. And then you ultimately end up with earnings after taxes, and something sometimes also called EBITDA, which is earnings before interest and taxes, depreciation, and amortization. And those things we'll talk about a little bit more as we go along. Here's just a basic income statement. It's kind of good, look through that, kind of get an idea what you're looking at. You'll be looking at a lot of these throughout the semester. So capital, right? Capital is the investment into the company, right? And capital can come in 3 forms. Okay, bondholders. That's people that lend money to corporations. Long ago, corporations discovered that they didn't have to necessarily go through a bank. Big corporations, anyhow, they could issue their own bonds, corporate bonds that people would purchase to get interest. It's really not unlike having a CD at a bank. So if Microsoft wants to issue some bonds, and they do, okay, even though Microsoft has tons of cash on hand, they still issue some bonds, and you and I could buy the bonds, and Microsoft would pay us a certain rate of interest for a certain period of time, and then ultimately when the bond came due, they would pay us back the money that they borrowed. Okay, common shareholders then are folks that's typically when we say we're following the market or looking at those things, or the Dow Jones Industrial Average or the S&P or the NASDAQ, okay, that's what they're giving us is how those common shares are being traded. Common shareholders are the people that actually own the corporation, okay? Preferred shareholders or preferred stockholders are something in between. Okay, they're kind of in between a bond and a common shareholder. Typically, preferred shareholders, they get interest or dividend payments, just like bondholders receive interest. Okay, and some of them also they can have they can take advantage of increases in the stock price as well. So preferred stocks are kind of a hybrid. Now, the negative about preferred stocks is that the interest or the dividends that they pay on those are not deductible tax-wise for the corporation that's issuing them. So they're pretty rare. They're a pretty rare breed. They don't get issued too often because it's not very advantageous for the company issuing them. It's very advantageous for the person investing in them. There's a lot of interest in people that would like to buy preferred bonds. Okay, for that reason, sometimes it makes sense to issue them because the bondholder or the preferred shareholders are willing to accept a little less return, in exchange for the fact that they're considered a preferred shareholder. So, earnings per share is ultimately what we like to figure out as shareholders, right? We want to know how much, if I own one share of Apple, how much did they make last year for that share of Apple, right? Based compared to what I paid for it. It's really important. Statement of retained earnings says that, okay, we figure out what our net income is, but then sometimes we also pay out dividends, right? Okay. And, once we pay out those, okay, this is saying what it was last year. So we added 100 grand in earnings, but we paid out 50 grand in dividends, and so we ended up with retained earnings of 300,000. One other item for publicly traded companies that's become more important recently is share buybacks. A lot of companies are buying back their own shares. If you look at big companies, Apple, Microsoft, several others, they've just got a steady program of buying back their own stock. We'll talk a lot about that throughout the semester, so I'm not going to, go at length at this point in time. But the price to earnings ratio is simply, and if I'm done here and I remember, I'll show you an example, but it's just simply a ratio then of the price that a stock is currently selling for. So if a stock is currently selling for $100 and the company earned $5 last year in 2022, okay, then the price to earnings ratio for the 2022 earnings it'd be 100 to 5 or 20 to 1, right? If you do the math there, okay, or a price to earnings ratio of 20. Most people just look at that and say it's 20, right? Okay. This is kind of an important thing. It can be an apples to apples comparison at times. Sometimes it's kind of apples to oranges depending. Usually high growth companies, I'll give you a usually here, high growth companies that are new and that are growing rapidly have higher price to earnings ratios when you look at them. The reason for that is because the expectation is that they're going to continue to grow, right? And oftentimes their earnings are also low when they get started. I think Tesla, even though its stock's been beat up quite a bit, I'll bet you they still have a fairly high price to earnings ratio. Okay, things that influence it, of course, are all those things there. And we'll talk about this some as we go along. I don't necessarily deem the PE ratio to be a huge deal for business finance. It's not something that we necessarily are gonna do a lot of stuff with. Your project 2, you're going to take a look at it, and so certainly we'll talk about it. So, limitations of the income statement, right? Just all kinds of things can happen in a quarter or a year that don't really have an effect over the long term for a particular corporation. COVID years are a good example, right? A lot of companies took a big hit. Some companies did extremely well, like Zoom, because people had to stay home, and so those companies that were set up for that, Netflix, those companies did extremely well, but other companies not so well, right? Okay, and so those types of things can impact companies in the short term, but not necessarily over the long term, right? A lot of things that are out of your control. The oil industry, gosh, prices go up, prices go down, not necessarily dependent on anything they've done, but it certainly affects their income, right? flexibility in reporting transactions. We see that, look at our local farms and ranches. I just give you an example. Some of my old farm customers I knew quite well. If they had a really good year, let's say in 2022, towards the end of the year, they might try to pre-buy not all, but a lot of their next year's supplies, or fertilizer, seed, those types of things, so that expense could be on 2022 to offset the income from 2022. Okay. Yeah, might create some problems in 2023, but we'll worry about that in 2023, right? Same things happen with big corporations in terms of realizing income, etc. The balance sheet is just what a company owes and what a company owns versus owes, right? So you got to remember, go back to the simple accounting equation, right? Assets equal liabilities plus owner's equity. And you can restate that, several different ways. Assets minus liabilities equal equity. Assets minus equity equal liabilities. Okay? But the left side of a balance sheet is always going to be assets. The right side of the balance sheet is liabilities at the top and equity at the bottom. Okay? It's really that simple. Okay? I think sometimes we try to overcomplicate it. And don't get me wrong, there are some complicated things that end up in there. Like accumulated depreciation or accumulated amortization, those types of things, and goodwill that end up on those balance sheets that look a little bit confusing. And we'll talk about some of those, right, as we go along. But yeah, big difference, it says here, between the cost basis or the accounting basis of a balance sheet and what the market value is. And we talk a lot about that as we go on. So we got to remember that we got current assets. Current assets are anything really that can be converted to cash within a year. Okay, can or will be converted to cash within 1 year. Okay, current assets themselves, marketable securities. Sometimes investment securities are in long-term assets because that's how the company chooses to recognize them. Again, a little more complicated than we need right now. Accounts receivable, those are things that, you've sold something, but somebody's going to pay you probably within 30 or 60 days. An inventory are those things that you're going to make or buy or have bought and that are going to be converted to cash, hopefully in relatively short order. Prepaid expenses, okay, can be that way too, as a current asset. Investments, on the other hand, over 1 year. Now we're getting into more fixed assets or long-term assets, right? And that also includes plant and equipment, right? If you've got a plant or equipment, real estate, those types of things, right? So then the total assets are the combination of current assets and fixed or long-term assets, right? Liabilities are kind of broken down that same way. There's current liabilities and there's long-term liabilities, right? Current liabilities are those things that are owed within 1 year. One thing you get on current liabilities are current portion of long-term debt, or CPLTD. Okay, that's those things. If you make payments, say monthly payments, right? So you got a mortgage on your house, a little different than a business, but you're going to be making monthly payments. Well, how many payments are you going to have to make in the next 12 months? That's a current asset, is those payments, whereas the mortgage itself is a long-term, liability. And then when you subtract the liabilities from the assets, you should end up with owner's equity. And sometimes that's negative. What's amazing is we'll see some companies that when we look at it, that will actually have a negative accounting net worth, but the market values them at billions of dollars, maybe even $1 trillion. It could be that one or two of the biggest companies, Apple, Microsoft, might even have a negative accounting net worth, and yet the market values them at something more than that. That's some of those quirky things that we'll look at as we go along. There's balance sheet. Now they've got the assets on top, liabilities and equity on the bottom, and that's fine. A lot of them are set up that way. I'm used to looking at them where the assets are on the left over here and liabilities and equity are on this side. Okay, see $1 million in total assets, $1 million in liabilities and equity. They call it a balance sheet for a reason. And then you get the net worth or the equity, and that's again just the difference, right, between the two. But you arrive at that in different ways in terms of recognizing your income, the retained earnings, et cetera, et cetera. There's a lot that goes into it, and that's why you're taking this class, so that you'll learn some of that goes into that. So limitations of the balance sheet. And this is why there's some quirky things, right? Most values are based on historical or original cost price. So if you're a farmer, let's just say, again, break this down real simple, um, and you bought land in 1965. You're an old guy now, right? Or an old gal. And what's that land worth? Okay, you paid $30 an acre for it. It's maybe worth $1,500 an acre, right? What's it show on your balance sheet? To do it properly on your balance sheet, it still shows up as $30 an acre. Okay, land doesn't depreciate, so you didn't depreciate it. Okay, so you've got this huge asset, right? That's worth a lot of money, but that's not how you show it on your balance sheet. I'm just trying to make give you guys an idea what happens with big corporations. In some cases, there are other things that go into that too. It's the same with big warehouses and big plants, right? Manufacturing plants and those types of things. Okay, those get depreciated. So you might build a big manufacturing plant, and you might spend billions of dollars on it, and 15 or 20 or 25 years later, it's totally depreciated. So on your balance sheet, it shows up as being worth zero. But in real life, it could be worth many times what you originally paid for it, right? Through inflation and those types of things. So FASB, the Financial Accounting Standards Board, right? Okay, they don't allow adjustments for inflation. Companies can do that, I think, if they want to. We don't get into that too much. I'll leave that for the accountants probably. Okay, so differences then, and again, when we get into Project 2 especially, you guys will see this, where we look at a book value that they actually report, but then the market value and what the huge differences can be. This gives you some examples here, and those are in your book. It's pretty easy to look up real examples, and we can do that. Statement of cash flows. You got to have cash. Cash is king, right? And so this is huge, right? So it emphasizes the critical nature of cash flow. And so we take a look at that, and there are companies that can show profits and not have cash, and there are companies that can have lots of cash and not show profits. and those are some things. We'll kind of look at some reasons for those as we go along. I don't want to spend a whole lot of time talking about it now because it's that important, and we get into it fairly deeply as the semester rolls along. Accrual versus the cash method. Most companies use an accrual type of accounting where you realize things maybe even before they happen because they are going to happen, if that makes sense. So you might have some expenses that you show. For example, taxes. We pay property taxes in Montana. Your first half for 2023 are due not until November, right? Okay, but to properly account for those, and you do every month so that your monthly statement looks right, you take a portion. So if your taxes are going to be $24,000 for the year, you would show a $2,000 expense every single month. That's just one simple example of what accrual accounting in versus cash accounting would say. You don't recognize that expense until you actually pay it. So the first half doesn't get paid until November, and the second half actually doesn't get paid until the next May. And you can choose, right, how you want to, as a business, how you want to account for things, either on a cash basis or an accrual basis. Probably most really small companies use a cash basis. As companies get bigger, they tend to use more of an accrual basis. The statement of cash flows, they break it down into these things: operating activities, investing activities, and financing activities. Operating are those things, right? You buy inventory, you sell inventory, you pay your operating expenses, do you get some cash out of that? Yep. Investing activities are, are you buying some investments, doing some things like that? You're buying property, plant, equipment, which might cause money to go out, right? And then cash flows from financing, are you getting cash in because you're borrowing money? Okay? And then you end up with a net in your cash flow. It talks about, determining the cash flows, right? Again, a direct method. So if you're doing the accrual thing, okay, then you have to make some adjustments to show that going on your cash flow to show that maybe you haven't actually expended that cash and that you're not going to expend that cash until November. And so you're going to have to make adjustments, if we're talking about the property taxes again, for those 10 months, okay? And you know, that, again, that's an accounting thing. That's we'll let the accountants worry about that. We'll talk about how we kind of investigate that as people that are a little more interested in the finance side. And again, we'll talk at length about some of those cash flow things, but you can certainly look at these and it'll give you some ideas, right? Investing, right? Mainly plant and equipment, but for a lot of companies, it's other things too. So, financial activities, right? Borrow money through bonds or paying off bonds, you know, common stock. Or are you buying back stock like we've talked about? Maybe issuing more stock. That happens sometimes too. Companies maybe that are growing or companies that are having difficulties. Yeah, we talk about a lot of those as we go along. There's a kind of a combination statement of cash flows. Things here you can kind of take a look at. I'm getting a little long-winded here, so I'm going to try to get through this a little bit quicker. But depreciation's a big deal, right? Okay, you buy something and it does depreciate in value, just like your car. You know, think about that, right? If you buy a brand new car in 5 years, is it worth less? Yeah, it's worth a lot less, right? You pay $30,000 for a car, and in 5 years, it's maybe worth $15,000. Okay, so it depreciates over that 5 years, and in a business sense, if you're buying equipment, let's say it's a payloader, okay, and you pay $200,000 for it, in 10 years it may be worth little or nothing, right? Okay, and so you're allowed to depreciate that. That's a tax thing, right? So if you do straight line depreciation, then you would take over 10 years, 10% of that value as an expense for each of those 10 years. So you pay $200,000 for it. Each year you would expense. You don't get to expense the $200,000. All you're doing there is trading assets. You're trading cash, say, for a physical asset, their equipment. Okay, so that doesn't really affect your balance sheet or anything, or your income statement. It certainly does. I'm sorry. It definitely does not affect your income statement. It has very little effect so far on your balance sheet. But each year that goes by, then you get to take off 10% of the cost, right, as depreciation. And so, you know, then in year two, your payloader is only worth $180,000. So that changes on your balance sheet, and you show some accumulated depreciation. And again, we'll get into that a little more deeply, right? But that also becomes a non-cash expense, right? Okay, you've already expended the cash in that first year, and so it becomes a non-cash expense as you go along. And we do a few exercises. You'll do some of those fairly early on, right? Okay. Free cash flow is a big deal, right? So you get your cash flow from operating, but then you also make capital expenditures, buying plant and equipment, and you pay dividends, maybe stock buyback, those types of things. So what kind of cash then do you have left to do other things, maybe some other financing activities, buying other businesses, etc. Income tax. Hopefully I got that right now. I think I've changed that and updated that. I'm pretty sure that the corporate tax rate is 21%. Okay, small businesses are not necessarily corporations and aren't taxed like corporations. We're going to talk a lot about that in Project One. But for corporations, then they have to pay those income taxes, and it's a huge deal. It's here's one of the reasons. This is kind of a quick little down and dirty, but it's one of the reasons that I'll tell you often that debt is cheaper than equity. Okay, and it's because debt, you get to deduct those interest payments. Okay, so debt becomes cheaper than equity. Oh, I'm getting long-winded. There's your depreciation as a tax shield. It's just that depreciation is a deductible expense. It's a very real expense. A lot of people don't recognize that, you know, but it's a very real expense, but you write off things over time as opposed to right away. There have been some tax laws sometimes that have been changed to allow more immediate write-off of those things. There we go. Sorry I got so long-winded again. I promise I'll try to keep these a little bit shorter. Where's my deal so I can... review your accounting a little bit, go through this, be up to date a little bit on it. after this, we're going to be doing a lot of problems. That's going to be kind of your weekly thing. I'm not going to talk very much, after today, in terms of, I'll send you out a little reminder video probably each week, and that'll be about it. So have fun with this. Good luck, and holler if you have any questions.